Now, basically here, the implication is that suppose the debt is permanent, then the present value, we can calculate the present value of the tax shield is 28 divided by 0.08, which equals 350, right? And what is the 0.08 here? This is going to be the expected return on debt, right? Now, that being said, the present value of the tax shield is actually independent of the return on debt, right? The main reason is that you have return on the debt both on the numerator, also in the denominator. That's why they cancel out when you calculate the present value of the tax shield as the ratio. Because here the interest payment is return on debt times amount borrowed, right? RD times D. Now the debt, so basically if we introduce tax here, we actually can still have the Miller-Morgellini hold, right? With one extension, right? The extension here is that the MM still holds because the pi we are talking about, or the firm value we are talking about, it is the value of before tax cash flow, right? This is one definition. You can think about that as one version or one definition of MM, right? Where the tax policy still, when we introduce the tax policy here, the debt ratio still doesn't affect the firm value, right? Of course, if you define the firm value as the after-tax cash flow, then Miller-Morgellini breaks down, right? The firm with a higher debt ratio is going to have a higher firm value, right? But if we still define the firm value as the before-tax cash flow, then it doesn't matter. That tax policy doesn't change the conclusion of the Miller-Morgellini. Because if we define the size of the pie as the value of before tax cash flow, then the before tax cash flow still is the same. Right? The difference here is that the government gets a slice of the pie, right, relative to the original MM. Right? So here the capital structure or the financial policy here affects the size of that kind of slice, right? Affects the slice of the government or the IRS, right? But doesn't change the overall size. So here the interest payments are tax deductible, right? So that's why the PV of the government slice can be reduced by using debt rather than equity. Yeah, because again, if you borrow more, you have this tax shields, right, which helps you which helps you reduce the after tax income, right? So sorry, before help you reduce the tax payment, right? So therefore, it increase your after tax income. Now, what are the tax? So let's look at this tax savings of that again, right? So if suppose the marginal tax rate is tau, the tax for the unlevered firm is tau times EBIT, right? This is earnings before interest and tax, right? Now, tax for the levered firm is tau times EBIT minus interest, right? Because this is the pre-tax income or taxable income. Right? Now the interest tax shows tau times interest, right? And the interest is RD times D, right? So now the interest tax shows is tau times RD times D, right? This is again every period's interest tax shields. Right? So basically here, only the interest payments reduce tax, right? Not the principal. It doesn't matter how much principal you pay, right? It's the interest payments. Now let's look at this table on the book, right? So how do interest tax shields contribute to value of the shareholders' equity, right? This is the normal balance sheet, which has asset value, which has debt, and total assets, total value. Our total value equals debt plus equity. Now, let's have an expanded balance sheet, right? Expanded balance sheet, we have pre-tax asset value, right? This is present value of pre-tax cash flow, right? So again, this one incorporates the debt, right? The debt payments, the interest payments. On the right-hand side, we have government here, right? This is government's claim because we introduced the tax policy here. The total of the debt and the government's claim and equity equals the total pre-tax value. Now, the lower tax payments make shareholders better off, right? Because obviously it increases the pre-tax income for the levered firm, right? if you increase your debt ratio, basically. So that's why one thing one company can do is to borrow money and increase the cash flow to debt and equity investor. And the after-tax value of the firm, right? The after-tax value of the firm, which is the sum of the debt and equity values, goes up by the tax shields, right? By the present value of the tax shields. Now let's look at this example, right? This is Johnson & Johnson's capital structure. The panel on the top is the book value. The panel on the bottom is the market value, right? And it's a simplified balance sheet, right? So here, we assume that the company has this amount of long-term debt, right? And we can calculate the PV of the interest tax shields, right? And then when we calculate it, we assume there is a 35% tax rate, right? And this is the PV of the tax interest shields, right? Now suppose what we do is that we decide to borrow additional 10 billion on a permanent basis and use the proceeds to repurchase shares, right? So this is a way to hedge the capital structure, right? By increasing the debt ratio. This is the 10 billion, right? So now what happens is that the book version of the balance sheet has 10,000 million more long-term debt, right? Because originally is this number, right? Now it has 10 billion more, which is 10,000 million, right? So the book version simply has 10,000 million more long-term debt and 10,000 million less equity. I remember it borrows 10 billion more to repurchase shares, right? So that is the idea. Now we can calculate the increase in the tax shields, right? The present value of the tax shields, which is gonna be 0.35 times the amount to borrow, right? So that is 10,000 million. So which will be equal to 3,500 million. Right? So in our case, if the MMCR holds except for taxes, firm value must increase by 3,500 million to this number. Right? This is the benefit of the tax shields. And if we look at equity, suppose it's like 293,100 million. So in our case, you can see you have repurchased 10 billion worth of shares, right? But the equity value has dropped by only 6.5 billion, right? So in that case, you can see Johnson & Johnson's shareholders is 3.5 billion ahead, right? That is 10 minus 6.5 billion. Right? This is the benefits of the tax shields. So formally, the value of the firm could be written as the value of the firm if the firm is all equity financed plus the present value of the tax shields. Right? And in a special case of fixed permanent debt, the value of the firm will be equal to the value of the firm if the firm is all equity financed plus the tax rate times the interest payments. Right? Again, this is the present value of the tax shields. So, and then the firm value and shareholders' wealth continue to go as the D increases, right? So there's no reason to hold less debt, right? According to this theorem, right? So all firms should be 100% debt financed, right? Obviously, this is too ideal because again, we need to consider bankruptcy costs, which we're gonna talk about later. Now again, here this is calculating the tax shields, right? You can look at it. Right, so suppose firm A is all equity finance, right? And suppose the firm A's cash flow is 1 minus tau times x, right? This is the tau here is the tax rate, right? Then this is the after-tax cash flow is going to be 1 minus tau times x. Now suppose firm B is identical but maintains debt with value D, right? And what that means is that the firm pays a perpetual expected interest, which is the expected return on debt times the debt, the value of the debt, right? Now the value of the I mean, the after-tax cash flow for company B is going to be 1 minus tau, right, times before tax income, right? What is before tax income is going to be X minus RD times D, right? And when we consider cash flow, we also need to consider this tax saving, right? So then it's going to be 1 minus tau times X plus tau times RD times D, right? Because when we consider cash flow, this is potentially what you potentially have saved, like tax deduction, right? Now in that case, you can see the CB will be equal to CA, right? This is the cash flow of the firm A plus this cash flow, sorry, plus this tax shields, right? So that's why the cash flows differ by the tax shields here. So this is why the firm value or the cash flow for a firm with a higher debt ratio should be high, right? Essentially because it has a lower pre-tax income, right? Hence, it will have a higher after-tax income, right? So that is the idea. And suppose we want to value a firm knowing that this relationship holds, right? That is CB equals CA plus the tax shields, right? Now, if we apply the value additivity, meaning that if we can separate the value, the present value of the CA and the present value of the interest tax shields, we can write as the firm value of B will be equal to firm value of A plus tau times D, which is the present value of the tax shields, right? So basically here, what we learn is that raising debt actually does not create value, right? But you cannot create value by borrowing and sitting on excess cash flow, right? The tax create value relative to raising the same amount in equity. This is why we find that actually a firm with high debt ratio has high firm value, right? It's not because raising debt create higher value. It's just that compared to the firm that try to raise it in equity, tax creates value. Right? So this is why we might actually consider debt financing relative to equity financing, right? Because debt financing has this benefits of tax shields. Right? So again, this is not saying that firm have a firm who have a debt ratio necessarily have a firm value, right? It's not saying that. It's just that when everything else is the same, right? When the before tax cash flow, so earnings, sorry, before tax and before interest tax flow cash flow, which is earnings before interest and the tax, if they are the same, right? In that case, then tax creates value, right? So this is the basic assumption we need to clarify, right? So that is tax creates value relative to raising the same amount in equity. So value is created by the tax shield when you try to finance the investment with debt rather than equity, right? And also when you undertake a recapitalization, right? Basically, what is recap here? Recap is a financial transaction where some equity is retired and replaced with debt, right? Like we borrow some money to repurchase the shares, right? So this is kind of the idea. So let's look at in reality, what are the potential magnitudes of interest tax shield, right? Suppose firm A has no debt and then the worth V, right? And suppose firm A is all equity finance, right? Now suppose firm A undertakes a leverage recap, right? For example, the firm A issues debt worth D, right? And then the firm buys back equity with the proceeds, right? We purchase equity with the proceeds, right? Now the new value is going to be so this is the equation we just saw, right? The value of the levered firm equals the value of the unlevered firm plus the present value of the tax shields. Okay? Now suppose the corporate tax rate is 35%, right? Now for that ratio that is equal to 20%, the firm value increases by about 7%. Right? Now for that ratio that is equal to 50%, it increases by about 70.5%, right? So that is the idea. So the bottom line here is that the tax shield of that matters potentially a lot, right? So the pi theory gets you to answer the right question, right? How does this financing choice affect the government bites of the corporate pie, right? Like we just said. It's not, again, this is not about having that ratio, having a high debt ratio creates value. It's basically a choice of financing, right? It's a choice of financing. When you try to raise the same amount using debt, you have this advantage of tax shields, right? The tax benefits. Whereas if you raise the same amount using equity, you don't have that kind of benefit. So basically, it is standard to use this tau times d for the capitalization of debt tax break, right? But the caveats of this theory, caveats of this modified NMS theory is that not all firms face full marginal tax rates, right? Because it's too, because I mean, if you have lower income, of course you have a lower tax rate, right? Because the tax rate is tied to the tax rate determined by different tax brackets, which is in turn determined by different income level. Another caveat here is that you also need to consider the personal tax rate, right? Because bondholders, shareholders, they also, when they receive dividends, you need to also consider their personal tax, right? Because if you issue equity, one of the advantage for the shareholders that maybe they're going to receive dividends. Right? Now we're going to talk about personal tax, right? Here, the important thing is that investors' return from debt and equity, they are taxed differently. And so here, interest and dividend income, they are taxed as ordinary income. Right? But capital gains, they're taxed at the lower rate, right? Which is the capital gain rate. Right? And capital gains could be deferred, right? But dividends and interest, the tax on the dividends and interest payment, they cannot be deferred. Right? So what are the capital gains? Capital gains is basically the tax you have to pay when you buy and sell stock, right? For example, this is how much. This is basically the capital gain tax, and that's why the capital gains, right? So that's why the capital gain rate is lower, right? And also because capital gain rates or capital gains could be deferred, right? You don't have to pay right away. That's why the effective tax rate on the capital gains is even lower. Right? So therefore, for personal tax, actually equity is better, right? Because if you issue equity, investors only have to pay capital gain rate, which is lower, right? Then if you issue debt, right? Because if you issue debt, you have to pay a higher personal income tax. Right? So basically, now let's compare the corporate and the personal tax, right? Firms that they need to basically minimize the present value of all tax paid on the corporate income. Right? And I mean, of course, the personal tax is also incorporated here because remember, we are considered shareholders, right? We are considered the tax burden for the shareholders, right? And then shareholders own the firm, therefore corporate tax is also basically shareholders' burden, right? So basically here, the all tax should include personal tax paid by the bondholder and the stockholder. So depending on the firm capital structure, $1 of operating income will accrue to the investor either as a debt interest or equity income, right? If it's equity income, then you need to pay tax on dividend income, and also you need to pay capital gain tax. So now let's look at this graph, right? This graph, you start out by having the same operating income as $1, right? Now suppose you paid out this $1 as interest, right? So this is one choice. The other choice is that you paid out this $1 as equity income. All right. Now, if you pay out this $1 as interest, basically you don't have to pay corporate tax, right? Because again, the reason is that you have this tax shield. Yeah, the tax shield makes sure that you don't have to pay corporate tax on that, right? And basically, if you paid out this $1 as interest, this goes to bondholder, right? And if I mean, basically, you are just paying out your debt, right? If you are paying off your debt, of course, you don't have to pay corporate tax, right? Because this is just you paying your bondholder. It's like you borrow from the bank, you pay them, right? You have to pay tax on that. But for the bondholder, they have to pay personal tax, all right? So that is if we so their income after corporate tax is still going to be $1, but they have to pay personal tax for this $1. Yeah? Now, in that case, for bondholder, your income after all tax is going to be 1 minus TP. TP here is the personal tax. And suppose you paid out as equity income. If you paid out as equity income, then shareholders have to pay corporate tax, right? Because this is part of their equity income, right? Now the rate is TC, right? Now in that case, the income after corporate tax is going to be 1 minus TC, right? Now on top of that, shareholders also have to pay personal tax. Right? This is basically the personal tax on the equity income, right? And this is different from the personal tax on the interest income. All right, remember what is interest income? Interest income is basically the amount of interest payments received by a bondholder, right? Because you pay them interest payments every period. Right? And then this personal tax rate on the interest income is different from the personal tax rate you paid on equity income. Right? Now the personal tax you have to pay is going to be PPE, right? This is the tax rate you pay, tax rate for the personal tax rate on the equity income, right? Times 1 minus TC, right? Now at the end of the day, the income after all tax here is going to be 1 minus TPE times 1 minus TC, right? This is the income after all taxes, right? And then this goes to shareholders, right? So the firm's objective should be to arrange its capital structure to maximize after-tax income, right? And the personal tax rate on interest is going to be TP. And the effective personal tax rate on equity income is TP, right? Just like we talked about. Now we have two income after all taxes, right? For the bondholder and for the shareholder. And basically, now let's compare these two income, right? Here, the corporate borrowing will be better if 1 minus TP is more than 1 minus TPE and times 1 minus TC. Right? So that is the corporate borrowing is better for the bondholder, right? This is better for the bondholder. In that case, the corporate borrowing will be better for the bondholder. Bondholder will be willing to lend to you, right? Basically, that's the idea. But if it's the other way around, then I mean, if it's the other way around, for example, 1 minus TP is less than the right-hand side, then shareholders are better off if you do corporate borrowing. So shareholders are better than bondholder. Right? Now, in that case, the relative tax advantage of debt over equity is going to be this ratio. Right? So, and this 1 minus TC should be in the denominator here. This is the relative tax advantage. Now, in a special case where this personal tax on equity income equals the personal tax on the interest income, the relative advantage will be 1 divided by 1 minus TC, right? So basically here, personal tax reduce the dollar amount of corporate interest tax shields, but the appropriate discount rate for cash flows after personal tax is also lower, right? Because you can see this is the after personal tax return, which is RD times 1 minus TP, right? TP here is the personal income. This is the personal tax, right? And then this is the personal tax for the interest income, right? Now the value of the tax shields after personal tax is going to be the present value of the tax shields, right? Which is TC times RD times D times 1 minus TP divided by the after personal tax return for the debt holder, return on debt basically. And again, this is going to be TC times D, your tax rate times your interest payments. Let's look at a special case 2, right? So the special case 2 is when the relative advantage equals 1. Yeah? If the relative advantage equals 1, then what happens is that the second special case occurs when a corporate and a personal tax cancel out to make that policy irrelevant, right? So now you can see if we make these two things, the left-hand side and right-hand side equal, right? Of course, now the debt policy doesn't matter. Yeah? And in this case can happen if TC is less than TP, right? I mean, if this one is less than TP, right? And if TP is very small. Right? So if this one is very small, right? Then this might boost up this part, right? Which might make these two things equal. So when we consider the net tax advantage of that, we need to know the tax rate by a marginal investor, right? This marginal investor is equally happy to hold debt or equity, right? And basically, we need to know what is the tax rate this marginal investor is facing, basically. Yeah? Suppose the marginal investor is in the top tax bracket, right? And this marginal investor will pay 43.4 on interest, right? Again, I mean, why do they have to pay tax on interest? Because again, if you choose to issue debt, then this guy is gonna be bondholder, right? Then they have to pay 43.4 on the interest income, all right? Now, if you issue equity, then they have to pay 23.8 on dividends and capital gains. Right? Now, assume that the deferred realization of capital gains cut the effective capital gains rate in half, right? So that is the effective capital gain rate is going to be half of the original rate, right? It's going to be 11.9%. Right? Now, suppose the investor invests in the stock of the company with a 50% payout, right? Now the tax on the each $1 of equity income, it's gonna be 50% times 23.8 plus 50% times 11.9%, right? Now, why it's, now again, this 50% goes to dividend income right away, right? If you pay out dividends right away, you're gonna have to pay 23.8% on your dividend income, right? If you retain 50% as earnings, right, that means your capital gains are deferred into the future, right? Your capital gains are deferred into the future. That's why you will have to pay 11.9% for the rest of the 50%, right? Again, 50% is direct, immediate dividend payouts, right? 50% as the retained earnings, right? Basically, and then that's why the personal tax on equity income will be the mix of the two, the weighted average of the two, right? Which is 17.85%, right? That is the idea. Now, if we apply what we have here to this example here, I suppose the income before tax is the same, right? $1 for interest, $1 for equity, right? Now we are comparing debt finance and equity financing, right? After the corporate tax, right? Again, if you are bondholder, you have to pay corporate tax, right? Now in this example, bondholder they have to pay personal tax on the interest income, right? Which was 43.4, right? What you get is 0.566, right? Now, if you're equity holder, right, you have to pay corporate tax, right? You also have to pay personal tax on the equity income, right? Which is 11.116, right? Now, if you compare the income after all taxes for bondholder and shareholder, what you're going to see is that bondholder, they're going to have 0.5 566, right? The shareholder is gonna receive, if you do equity financing, right, then the stockholder is gonna receive 0.534. And the advantage to the debt is gonna be the difference of the two, right? Which is 0.032, right? So in conclusion, the advantage to debt financing appears to be about 3 cents on the dollar, right? So this is basically what we have gone so far, right? So if we consider tax, including both the dividend tax and the income tax, then we're gonna have everything here, right? So we're gonna have most company, we're gonna have basically the net advantage of debt is gonna be 3 cents per dollar, right? This is our conclusion. So basically, if taxes were the only issue, most company would be 100% debt finance, right? So this leads to the second part of this topic, which is what is the cost of having too much debt? That is the cost of financial distress. So if debt is always good, right, then common sense will suggest that you should always have 100%, but this is not true, right? Because if the burden is too high, the company will have trouble paying. The result is you'll have financial distress, right? And financial distress occurs when promises to creditors are broken or honored with difficulty, right? Now, in that case, when we think about the value of the firm, then we're going to add this cost of having too much debt into the equation. It's going to be value if all equity finance plus the present value of the tax shields minus the cost of the financial distress, right? Which is also in the present value terms, right? And the cost of financial distress here depend on the probability of the financial distress and the magnitude of costs encountered if distress occurs, right? Because if you think about this financial distress, right, when you have very high debt ratio, it's not guaranteed that you're gonna go bankrupt, right? But you just have that kind of higher probability of going bankrupt, right? Which is like a threat, right? So then this is the graph we are looking at, right? This is the value of all equity financed firm, right? They don't have to think about debt, right? Now, the advantage of debt is obviously providing you this tax shields, right? That's why if you increase the debt, it's gonna have a higher market value here, right? But now if you increase that ratio too high, then this is where the problem is, right? Now the firm value is gonna decrease, right? Because the cost of financial distress come in, right? Kick in to reduce your firm value, right? This is cost of financial distress. And this theory is what we call the trade-off theory of capital structure. That is, the present value of the tax shields initially increase as the firm borrows more, right? Which helps increase the firm value, right? At moderate debt levels, the probability of financial distress is trivial, and so tax advantages dominate, right? But at some point, the probability of financial distress increases rapidly with additional borrowing, right? And in that case, the cost of distress begin to take a substantial bite out of firm value, right? This is when you have too high a debt ratio, it's going to hurt you, right? It's going to reduce your firm value basically, right? And at moderate debt levels, the probability of financial distress is trivial, so tax advantages dominate, right? At some point where you have a too high debt ratio, the cost of financial distress becomes dominant, right? That's why the firm value goes down, right? And then you can see if you have this trade-off, you might actually reach an theoretical optimal capital structure when the present value of tax savings due to further borrowing is offset by increasing the present value of cost of distress. Right? Basically, you are balancing cost and benefits, right? So basically, firms in financial distress perform poorly, right? This is what we observe, right? But the question here is is this poor performance any effect or cause of financial distress? It could be that I have firm that are in financial distress perform poorly. It could be that a poor performance lead to financial distress, right? It can also be that financial distress, right? The fact that the firms undertake lots of debt causes the poor performance, right? We can never tell. But basically, firm distress can also be a cause, right? So it can result in partial or complete liquidation of the firm assets, right? And only the effects of the financial crisis should be counted as the cost, right? We should not take into account, let's say, we think that, oh, the firm has a higher debt ratio, right? And the firm is performing poorly, right? But this by itself, it's not a cause of financial distress, right? It could be that the firm is performing poorly originally, right, to start from. So that's why only the effects of the financial crisis should be considered as cost, right? And the cost of financial distress, as we talk about, we should differentiate between direct cost, which is direct bankruptcy cost, from indirect cost of financial distress, right? Direct bankruptcy cost is the legal cost, etc., right? Indirect costs are the costs that affect shareholders' incentive to take investment, for example, right? For example, it includes debt overhang, risk taking, and scale of customer and supply, right? We're going to talk about in detail. So when we look at the indirect cost of financial distress, we're going to look at basically three components, right? One is debt overhang. Right? So again, these three are about incentives of firms, of shareholders to take on investment, right? So it's not necessarily that this will mean that firm is definitely going to bankrupt, right? My firm might not go bankrupt, right? It's just that because of this threat of bankruptcy, because of this possibility of going bankrupt, then it will create different incentive or adverse incentive for the shareholders to take investment projects, right? This is kind of my view. And this idea might actually be, this incentive might actually will lead to kind of worse outcome for the bondholder. This debt overhang problem essentially says that the inability to raise funds to undertake good investment, right, which is caused by the possibility of having a financial distress. Basically, shareholders might pass up valuable investment projects, and competitors might take this opportunity to be aggressive, right? And also, the indirect cost includes risk-taking behavior, right? Gambling for salvation. Also, scare of customer supply, right? For example, if the customer, if your supplier knows that you're gonna go bankrupt, right? They might actually they might actually cut the contract with you, right? They might not want to, deal with you, right? Because they're afraid that you might actually default, right? And then the fact that you might go default means that your payments to them might not be honored, right? So this is kind of idea. Let's go from debt overhang. So this is the bankruptcy cost. So before we go to debt overhang, let's talk about bankruptcy cost for a little bit. Basically, the bankruptcy costs occur when shareholders exercise their right to default. Right? Again, this is direct bankruptcy cost. And basically, the former creditors become the new shareholders, and old shareholders are left with nothing. And this is solely based on the idea that modern corporations, they are limited liability, meaning that shareholders have limited liability for those firms. Right? And let's look at one example. Suppose each firm promised to repay $1,000 next year. Shareholders of this ACE Unlimited are personally liable for this debt, right? Again, for unlimited firm, shareholders are personally liable for the debt. Right? But for companies that are limited, which means shareholders are limited liability, right? Shareholders, they are not personally liable for the debt, right? It's like if the firm goes bankrupt, then the firm will be liquidated, right? And then what is worse as the remaining value of the firm will goes to the creditors, right? If creditors are not paid, right? And then if it's anything that's remaining, it goes to the shareholder, right? That's why shareholder gets the residual value, and also it has limited liability, right? For example, if the firm value is 50, right? But you owe creditors 100, right? The firm goes bankrupt. Now the whole 50 goes to creditors, right? And then creditors still have 50 to receive, but no one can pay them, right? Shareholders, they don't have to pay 50 to the creditors, right? That's why shareholders can get away with nothing. And also they don't have to pay anything, right? Now in our case here, suppose that next year the assets of each company are worth 500, right? In that case, the limited shareholders walk away, right? Their payoff is 0 because this 500 all goes to creditors, right? Then shareholders of the unlimited have to pay 500 in addition, right? Because they have unlimited liability, right? To compensate for the creditors, right? The right to go bankrupt or the right to default is a valuable privilege when performance is poor, right? So here, the bankruptcy is not a cost, but the result of the decline in value, right? Now you can see there's a huge difference for the shareholder and the creditors in this case, right? And here, the bankruptcy costs are the cost of using the legal mechanism that allows creditors to take over when a firm defaults. And the combined payoff to the bondholders and the shareholders of this limited company is actually the same as the combined payoff to the bondholders and the shareholders of ACE Unlimited, right? But the difference here, now you can see is that the combined payoff to the bondholder and the shareholders for the ACE Limited, right? It's because shareholders, they walk away with nothing, right? All that goes to bondholder, right? But the combined payoff to the bondholder and the shareholders for the unlimited company. The shareholders of unlimited company, they have to pay creditors personally in order to compensate for those interest payments, for these debt payments. Right? That's why it's the distribution that matters, or that is different between the unlimited company and the limited company. Right? The overall market value of these two firms is the same. So there are studies that look at the bankruptcy cost, basically, right? The average cost of bankruptcy, it's about 3% of total book value of assets, and 20% of the market value of equity, right, in the year prior to bankruptcy. And another study finds that estimated cost of financial distress, it will be about 10% to 20% of pre-distress market value. Right? And when we talk about direct bankruptcy cost, basically these are legal expenses, right? And also opportunity costs, which is like time spent by dealing with creditors, right? Because when you file for bankruptcy filing, basically the creditors will form a group and try to decide whether or how to liquidate or restructure the firm, right, to pay off that debt. But you have wasted time there, right? You'd have to, then you potentially give up many good investment opportunities, right? This is opportunity cost because you have to deal with creditors first. So in that case, creditors, they are not patient enough to wait for you to deliver like investment returns, right? And how important are direct bankruptcy costs, right? Prior study, they find that the bankruptcy costs are on average 2 to 6% of total firm value. And this percentage cost, they're actually higher for smaller firms, right? But this needs to be weighted by the bankruptcy probability, all right? And the overall, the expected direct cost will be small, right? The huge part will be like indirect cost, right? Which we're gonna talk about now, the debt overhang incentive. So let's look at the debt overhang incentive here, right? Suppose this company XYZ has assets in place, right? Worth this much, right? And then this depends on idiosyncratic risk, right? If the state is good, if the of a company is good, then there's 50% chance of this good state happening, right? And then in our case, the firm assets will be worth $100, right? And if the bad thing happens, then which also happens with 50%, right? Now in that case, the assets will be only worth 10, right? And suppose the company XYZ has 15 million in cash. And this money can either be paid out as a dividend or invested, right? Now, suppose there is a project that XYZ's shareholder is thinking about, right? And this project, initial investment is 15 million. Next year, there will be a safe return of 22 million, right? Now, in that case, suppose the risk-free rate is 10%, right? That is the rate that you need to discount the cash flows, right? Then we can calculate the NPV. The net present value of the project here is 5 million, right? Now, let's compare what are the benefits for creditors and what are the benefits for shareholders if the company takes the project versus if the company does not take the project. If the company does not take the project, then with good state, the asset's gonna worth $100, and then creditors are gonna pay 35, right? Shareholders is gonna receive 65 as the rest, right? But this is the kind of assumption here, right? We don't calculate these numbers from the assumption here. It's just given here. Now, if it's bad state, remember creditors, they have 35 debt to be paid, right? Now, if the company is go bankrupt, if the state is bad, the company is only worth 10, right? Now the company will go bankrupt, right? Because the 10 is not going to cover creditors' debt, right? Now all the 10 goes to creditors, right? Suppose this is a limited liability company for shareholders, right? Now in this case, shareholder will walk away with nothing. This is the case where if the firm does not take the project. Now, suppose the company does take the project. If the company does take the project, if it's a good state, then, which happens with 50% chance, then the assets are going to worth 100 plus 22. Remember, what is the safe return of the project? It's 22 million, right? Then the firm's assets gonna worth 122, right? And then in that case, 35, again, they can pay off their creditors, right? And then shareholders get the rest, right? Shareholders enjoy this safe return of 22 million. If the state is bad, which happens with 50% chance, right? In that case, the assets will be worth 10 plus the safe return, that's going to be 32, right? And remember, the company owes creditors 35, right? Then in that case, all the 32 goes to creditors. Again, shareholders get nothing, right? Now in that case, will shareholders of XYZ fund the project? So if they don't fund the project, they get a dividend of 15 million, right? Because I mean, the excessive cash is either paid out or invested in this project. If they fund the project, they're gonna get, if it's a good state, they're gonna get 22, right? If it's a bad state, they're gonna get nothing, right? And then if you calculate this, the present value of this cash flow for these shareholders, if they take the project, then it's gonna be 10, right? Now in that case, you can see shareholders will not want to take the project, right? Because if they don't take the project, they can enjoy this dividend, right? If they take the project, then they're gonna get lower present value of the cash flow, right? The key intuition here, the key reason why shareholders do not want to take the project, do not want to invest in this very profitable project here, it's because when there's a chance that firm goes to financial distress, right? When there's a chance that firm go bankrupt, the return of this project all goes to creditors, right? Creditors do not have to do anything. They just take the safe return away, right? In that case, shareholders get nothing, right? The fact that there's a chance that the firm is going to bankrupt makes that shareholders do not want to take the investment project ex ante. right? So this is kind of idea. Now you can see this is not caused by the fact that the firm is going to bankrupt, right? This is merely because firm has this probability of going bankrupt, right? Only this probability you can see affect shareholders' incentive to take investment, right? Shareholders now are reluctant to take this investment project, right? So again, shareholders will incur the full investment cost, but they receive only part of the return, right? Only when you have a good state, then shareholders receive the return. But for creditors, they don't have to invest anything, but they actually receive part of the return, right? 22 independent. So that's why the risky debts here act as a tax on investment. So that's why shareholders of firms in financial distress might be reluctant to fund the valuable projects, right? Just because most of the benefits will go to the creditors, will go to the debt holders, right? Now, suppose the probability of bad state is 2/3 instead of 1/2, right? In that case, the creditor actually can grab part of the return even more often. Right? Now you can see this is actually in the function of the chances of a bad state happening. Right? If the bad state is happening with higher chances, then the tax on investment is actually higher. Right? Now shareholders are even less willing to invest. Right? So this is the debt overhang problem. So what can we do about it? I mean, we know that when the chances of the firm going bankrupt is higher, this decreases shareholders' incentive to take risky investment. But what can we do about it, right? So there are two ways we are considering. So the first thing is the new equity issue, right? The second thing is that new debt issue, right? The third thing is financial restructuring. This is the three policy we can consider. And basically, financial restructuring basically is a way to change the capital structure of the firm, right? And this is usually done if the firm declares bankruptcy, right? If the firm declares bankruptcy, usually shareholders and creditors, they will form a group, and then they will use a formal bankruptcy procedure to restructure the firm. If they restructure the firm, this might resolve the issue that the firm might go bankrupt, right? This might actually put the company out of trouble, right? This is kind of the financial restructuring. So if we raise outside equity, right, the new shareholder must break even, right? They may be paying the investment cost, but only when they receive a fair payment for it, right? Because I mean, if you think about the incentive of the new shareholder, you also need to make sure that they are better off when they buy the equity, when they become the shareholder. Right? Now, existing shareholder, they are incurring the cost and they will refuse, right? Because they don't want to, I mean, they are incurring the cost, right? But they don't actually enjoy fully the return. Yeah? So because firms in the financial distress may be unable to raise funds from new investors, right? Because most of the benefits will go to firms' existing creditors as well. So again, I mean, if you're looking at the new shareholders, they also get a part of the return, right? They don't get a full return. That's why they also might refuse. Now let's consider financial restructuring. So financial restructuring is actually the way to go, right? We will show that if you do financial restructuring, it actually can avoid inefficiency, right? Basically, what we're gonna do is that we're gonna do a debt for equity exchange, right? Alternatively, we could do debt forgiveness or restructuring, rescheduling, right? Basically, we can ask the creditors or negotiate with creditors to allow the debt to allow part of the debt to be paid in a later date, right? So that the chances that the firm go bankrupt is smaller, right? In that case, shareholders now again have the right incentive to take investment projects. Right? So suppose the creditors reduce the face value of the debt to 24 million, conditionally on the firm raising new equity to fund the project. Right? Now let's look at the question again. Will shareholders go ahead with the project? Right? Now, if they don't take the project, everything stays the same. Now, if the firm takes the project, right? If the firm takes the project, then in the bad state, the firm will not go bankrupt, all right? Now, in that case, shareholders will have part of the return from the investment, right? Now we're gonna look at this, right? The incremental cash flow to shareholders from restructuring is gonna be, that's 78 minus 65, right? 78 is here, right? From 65, right? So this is the incremental cash flow to shareholders from restructuring if we compare taking the project versus not taking the project. Right? Now it's going to be 33 million with probability 1, 2, and 8 million with probability 1, 2. Right? And then this implies that they will go ahead with the restructuring, because if they go ahead with the restructuring, the net present value of taking the project is going to be 3.6 million, right, which is positive. Now, in that case, creditors are also better off, right, because they get 23 minus 35, right? This is incremental cash flow, 23 minus 35, right? And then plus the best day, right? Then they're going to get 1.5 million, right? They're also better off taking the project under the restructuring policy, right? Now you can see this is a win-win policy actually, right? Under this restructuring policy, both creditors and shareholders, they are better off taking the project, right? This is a win-win policy. So when we try to evaluate financial distress costs, we need to account for the possibility of this potentially mutually beneficial financial restructuring, right? But in practice, perfect restructuring is not always possible. We can do some kind of restructuring, right? For example, like we show in the example, we might actually negotiate with the creditors to delay some of the debt, right? Of course, there are limits to restructuring, right? Banks versus bonds, fewer versus many banks, right? If you have fewer bonds, then it might be better to coordinate, right? And also, you might need to consider bank relationship versus arm's length finance, right? Also, there might be simple versus complex debt structure you might need to consider, right? If you have already very complex debt structure, it might be difficult to restructure. Right? Now, finally, issuing new debt is also the alternative we can think about, right? But it depends on what seniority of the debt we are thinking about, right? Seniority here means the order of repayment, right? Senior debt gets repaid first. If we issue new debt with lower seniority, then it will not improve things, right? But because the tax of the investment from the senior debt holder does not change, right? And if we issue debt with same seniority, it might mitigate but not solve the problem, right? The idea is that you are basically just use the newly borrowed debt to pay existing debt, right? I mean, you might mitigate the problem for the present, but it does not fully solve the problem, right? You actually pay a smaller tax, right? If you issue debt with higher seniority, then it might avoid a tax on investment, right? Because the creditors gets a larger part of the payoff, right? But however, this might actually prohibited by covenants, right? Because the idea is that if any debt holder, they know that you're gonna go bankrupt, right? They're gonna impose covenants saying that you cannot further borrow anymore, right? Because they are worried about you defaulting on the debt. Right? This is the idea. So let's take a brief break and we now continue. So for banks, I mean for firms, to kind of avoid this debt overhang problem, right? So we have already talked about what the problem is. The problem basically is the possibility of having financial distress will lead to shareholders avoiding investment, or even if the investment opportunity is profitable. And we also learn that when the probability of having the financial distress increases, such kind of incentive are are even worse or even stronger, right? So this is the debt overhang problem. But to prevent this, firms, they will try to avoid too much debt, right? So I mean, it's because if you have too much debt, the kind of possibility of financial distress will become a problem. So firms will try to have less debt. But when you cannot avoid leverage, then the firm can structure liability so that they're easy to restructure if it's needed. For example, you need to do a good job in actively managing the liability. You also need, probably you want to rely on more on bank debt, and also you also want to have fewer banks, because in order to restructure, or in order to kind of optimally restructure liability, it is better that you have fewer banks, because if there are more banks, it will be difficult to coordinate between different banks. Because I mean, especially when your debt is of different seniority, it will be very, very difficult to coordinate. So for example, suppose your firm has $50 in cash and it's currently worth 100, right? And you have opportunity to acquire internet startup company for $50. But this company will either be worth 0, which happens with 2/3 probability, or 120, which happens with 1/3 probability in 1 year, right? And assume that there's no discount rate. So the question is, would you invest in a startup if your firm is all equity financed? The second question is, what if the firm has debt outstanding with a face value 80, right? So let's look at the first question. Suppose the company is all equity financed, then the expected payoff using the probability we see on the slide, it's going to be 40, right? That's the expected payoff. Now, if we calculate the NPV of acquiring this internet startup, this suggests that we should not acquire the startup, right? Because the NPV is negative, right? That's obvious answer. But suppose that a company is more leveraged, right? The company has $80 as the debt. Then without a project, the debt will be 80, right? And because the firm value is 100, that's why the equity will be 20, right? Now with the project, if the project is lucky, the debt is 80, right? So if the project is lucky, it's gonna, if the startup is lucky, it's gonna be worth 120, right? So that means the firm will not go bankrupt. Rather, that will be equal to 80. Equity will be equal to 90. All right. So because the company will be worth 120, right? And also you have $50, right? So you have 120 plus 50, so it's going to be 170, right? So in our case, equity will be 90, right? Now, if the internet startup doesn't go well, so that means it will only be worth 0. So in that case, you cannot pay off the debt, right? In that case, you will go bankrupt. So debt holder will get 50, right? So shareholders get nothing. Firm value is 50, right? So in that case, with the project, if you take the project, the equity holder will get 30, right? Debt holder will be 60, right? So that means shareholders will accept this project. So this is if the firm has leverage, right? So now you can see this is, I mean, you can see this is obviously a bad project, right? But now why do shareholders still invest in? Because they are kind of taking this risky project using debt holders' money, right? So because if the project fails, the shareholders can walk away. They don't have to pay anything. But debt holder is hurt, right? But if the project is successful, shareholders are much better off, right? So that's why So that's why shareholders do have incentive to take the project, even if it is not a best interest for the shareholder, for the stockholder. Right? So that's why if you take the project for shareholders, the expected payoff is 90 times 1/3. That's 30, right? For debt holder is 60, right? Now you can see taking the project is in the best interest of the shareholder, right? 20 to 30, right? But it is not the best interest of debt holder, right? They go from 80 to 60, right? They become worse off. So this is the second incentive. That is, shareholders might take excessive risk, right? To sacrifice shareholders' money, right? Because they are, oh, sorry, to sacrifice bondholder or debt holders' money. So shareholder are essentially gambling with creditors' money. The implication is that firms in distress will adopt excessively risky strategies to go for broke, right? It's like the last straw, right? You know it's risky, but you know that if the project goes well, then you're gonna avoid bankruptcy. So you just wanna take the risk and gamble on it. So the implication is that firms will tend to liquidate assets too late and then remain in business for too long, right? Because they're hoping that this one last draw will turn the firm into good fortune, right? This is good for equity holder because equity holder, if you are in a limited company, limited liability company, shareholders they have unlimited upside potential but bounded losses, right? Because why why they have bounded losses? Because even if the company go bankrupt, they don't have to pay anything, right? They just walk away, right? But that is the debt holder who suffer more in this situation, right? Like this example showed. Right? And there's also other incentives, right? So in general, financial distress is costly when those conflict interests get in way of proper operating investment division. And shareholders might prefer maximizing shareholder value at the expense of their creditors, right? So this is the conflict of interest that happens when shareholders and creditors have different goals when it comes to financial distress. Now let's look at another incentive. So this example, this is a circular file company, right? And this company has one share and one bond outstanding. So the face value of circular's debt is 50. That exceeds firm's total market value, which is only 30, right? So that means there is a chance of firm go bankrupt. So there's financial distress. Now suppose this company has $10 cash. Possible payouts for next year is 120, which happens 10% chance, and 0 that happens with 90% chance. And suppose the bond matures 1 year later, that means you have to pay to the bondholders money, right? So then the firm owner is essentially betting with bondholders money because the owner gets most of the loot if the project pays off, right? But if the project does not pay off, bondholders they will take the hit, right? That is, and suppose so that this is the risk-taking incentive. So there's also the risk-shifting incentive here. Suppose that the project's NPV is -2 and it is taken, right? So suppose that let's look at this balance sheet, right? This balance sheet is 28. The total value is 28. The firm value falls by 2, but the owner is $3 ahead, because the bonds value has fallen by 5, right? So this is an assumption. We assume that bonds value fallen by 5, but actually firm owner can still gain 3, right? 5 to 8, they can still gain 3. So that's why the $10 cash that is used to stand behind a bond has been replaced by a very risky asset worth only $8. Right? So this is the risk shifting. Shareholders try to shift the risk to the bondholder. Right? So this is all this about. So financial managers who act strictly in their shareholders' interest will favor risky projects over safe ones, right? Because shareholders become better off, right? But now you can see in this example, bondholders can go worse off, right? And in general, the temptation to play this game, to kind of take risky projects, strongest when the odds of the default are high, right? This is the in general conclusion. And the second, there's another game that managers might play, which is to refuse to contribute equity capital. Right? So still the same example, assume that there's a good opportunity comes up. So there's a relatively safe asset costing $10 with a present value of $15 and NPV equals $5. Right? Now in our case, suppose that 2 shares are issued to the original owner for $10 cash. Then a project is taken. So this is the original balance sheet. Now the new balance sheet looks like this, right? So this is the total value goes up to 15, right? Because there is a relatively safe project costing $10, right? And the present value is $15. Now in that case, NPV is 5, right? So that means shareholders might want to take it, right? And suppose that 2 new shares are issued to the original owner for $10 cash, right? The project is taken. Now the total value of the firm goes up by 15, right? Because the project delivers $15 cash flow. 10 is the new capital and 5 is the NPV, right? Because you borrowed, you have $10 cash, right? So overall, the firm value goes up by 15. And suppose that a bondholder receives a capital gain of $8, right? Now, in that case, the shareholder loses what the bondholder gains, right? So you can see bondholder receives a capital gain of $8, right? Because you can see 25 to 33, right? Now the the equity value goes up only by 7, right? That's 15 minus 8, right? The shareholders value only goes up by 7, right? But remember, shareholders, they invest $10, right? So this is the one of type of, I mean, it's similar to debt overhaul problem that we talk about, right? Shareholders, they put in the full investment, they incur the full investment cost, but they only receive part of the investment return, right? Instead, bondholders, they actually, they don't have to incur the full investment cost, but they receive part of the return, right? So that's why shareholders, they might not want to contribute any capital because there's a free riding problem here, right? Shareholders put in money, but they receive less than they put in, right? So the value of any investment opportunity to the firm's shareholders is reduced because the project benefits must be shared with bondholders, right? And that's why the greater the probability, and the reason why sometimes you need to share with bondholders because this default likelihood, right? The possibility of financial distress. So that's why the greater the probability of default, the financial distress, the more bondholders have to gain from investment that increase firm value, right? In expectation, of course, right? So that's why shareholders might not have that kind of strong incentive to contribute their equity capital, right? Because of the free riding problem. And there are also 3 more games here, right? Cash in and a run. So cash in and run, it means that shareholders are happy to take the money out in the form of a cash dividend, right? Playing for time means that in financial distress, creditors want to settle up. The shareholders delay this through accounting changes. Right? Finally, bait and switch. Right? So shareholders or managers might start with a conservative conservative policy. For example, they will issue a limited amount of relatively safe debt, and then they will try to suddenly switch to issue a lot more. Right? So in that case, because all the debt is risky, right? So that imposes a capital loss on the old bondholders, right? Because it increases the default likelihoods, which is also bad for the old bondholder, right? And also, you can see the problems we see here. We can summarize it as the agency cost of borrowing, right? Because the more the firm borrows, the greater is the temptation to play these games, right? The greater is the kind of the misalignment of the incentives between the managers and the bondholders, or between the shareholders and bondholders. But remember that ultimately the fall in value comes out of shareholders' pockets, right? I mean, because if the bondholders they expect these things to happen, right? They might actually raise interest rate spreads, for example, right? They might actually they might actually decide not to lend to you, right? So this is also the cost that you have to pay. And bondholders in many cases they will try to limit borrowing. That is, they are not willing to lend you anymore, right? Because of they anticipate that there could be such incentives. So let's look at this example. In this example, Mrs. Ketchup faces credit rationing, right? So basically, this guy borrows from the bank for $10, right? And there are two investment projects here. In the project one, it's a safe project that delivers payoff for 15 for sure, right? And project two, it's a risky project that delivers $24 with 50% chance and $0 for 50% chance, right? So in our case, for project one, the expected payoff to bank is 10, right? Because the payoff is 15, right? So basically the debt is certain to be paid off, right? You don't have to worry because you can see the payoff happens for sure, right? Now, in our case, the expected payoff to Mrs. Ketchup is going to be 5, right? So because the payoff is 15, right? 10 goes to bank, so 5 goes to shareholder. For project 2, that's not the case, right? For project 2, if the state is good, if the project goes on well, the project pays 24, so bank is happy, right? So they get 10, right? But the project doesn't go well, the payoff 0, so that means bondholder or bank doesn't get anything. There's nothing left there, right? So that's why expected payoff to bank is 5. In that case, expected payoff to Miss Ketchup, it's gonna be 0.5 times 24. So because expected payoff to Mr. Ketchup for project 2, if it doesn't go well, shareholders also get nothing, right? But if it go well, Mrs. Ketchup is going to get 24, right? That's the payoff if it's successful, right? The money they borrow from the bank, which is 10, right? So in that case, the expected payoff to shareholder here is going to be 7, right? Now, in that case, you can see bank, they are more willing to take project 1, but shareholder, in this case, Mrs. Ketchup, he's more willing to take project 2, actually, right? $7, higher than 5, right? So in project 2, there's only a 50% chance of payment, and the expected payoff to the bank is only 5, right? Now you can see this is the agency cost of borrowing, right? The objective function of bank and Ketchup is different, right? So in this case, you can see they have different choice of projects. They have different preferences for taking the project, right? So how can shareholders in these cases assure banks, right? So for example, they can give a veto power to banks if it comes to dangerous decision like this, right? Banks prefer to take project 1, shareholders prefer to take project 2, right? Also, debt contracts they can include provisions that limit dividends or equivalent transfer of wealth to shareholders, right? Also give lenders more access to the firm's books in the financial forecast. So to summarize, the trade-off theory of capital structure basically says a firm's debt equity decision is a trade-off between interest tax shields and the cost of financial distress. Okay? And companies with safe tangible assets have plenty of taxable income, and basically they will need to have high target ratio, right? Because they have capacity to take debt, right? And then they have capacity to enjoy these tax shields, right? So that's why they need to, it will be beneficial for these firms to borrow more, right? But for unprofitable companies with risky intangible assets, it will be better for them to rely on equity financing, right? Because for them, the default probability, the cost of financial distress will be higher, right? In our case, having a high debt ratio might not be associated with a high firm value, right? When it comes to choose equity or choose debt to finance the projects. So there are always costs in adjusting to the optimum, right? Which is the cost of adjusting capital structure, right? So therefore, we see random deviations from the target debt ratio here and there, right? So this is the trade-off theory. So let's look at some empirical evidence of this trade-off theory. Basically, a firm manages capital structure to maintain a single A bond rating, right? So the trade-off theory actually explains many industry differences in capital structure, right? For example, high-tech growth companies use relatively little debt, and airlines can do borrow heavily because their assets are tangible and relatively safe, right? I mean, their businesses are relatively safe, right? So that's why they actually do borrow more. And but we also see some failures of this trade-off theory. For example, it cannot explain why some of the most successful companies thrive with little debt, right? For example, Johnson & Johnson has most of its assets as intangible assets, right? And Johnson & Johnson is doing well, right? And usually, intangible assets, like we said, because it is risky, right? So therefore, we recommend conservative capital structure, right? So in this case, Johnson & Johnson has large corporate income tax bill and the highest possible credit rating. So basically, the reality is that the most profitable companies commonly borrow the least, right? I mean, on one hand, they don't have to borrow, right? Because they have high profits, right? They don't need to enjoy these tax shields to borrow more, right? That's why, I mean, with the trade-off theory, it seems that if they have very high profits, right, and a high cash flow, they might actually want to borrow, but instead they don't borrow, right? So the reality is that the most profitable company actually do not borrow the least. But on the other hand, it also has some support for the trade-off theory because the trade-off theory also says that if you have intangible assets, right, you better not borrow too much. So basically, how to find optimal capital structure, right? We start from MM irrelevance theory, right? Where the tax policy doesn't affect, so where there's no tax, right? And in our case, that policy is relevant, right? Now based on that, we add two ingredients that change the size of the pie. Again, remember what is the pie here? The pie here is the earnings before interest and tax. Right? So this is the pie we are talking about. When we add taxation, we also add distress costs, right? Trading off these two will give you the optimal one, optimal capital. Right? So this also predicts that the debt ratio will be stable over time. Right? So this is expected distress cost, right? We already see it. So basically, taxes, basically expected distress cost is the function of the following things, right? Cash flow volatility, need for external funds, competitive threats, customers care about distress, and how to redeploy assets, right? All these factors will suggest that you have a high expected distress cost. Right? For example, if your cash flow is volatile, that means you might have periods where you do have low cash flow, right? So in those cases, you might not be able to pay off the debt. That's why you might suffer from financial distress. Right? Another factor, for example, if your customer care about financial distress, right? So that means if you are more likely to go into financial distress, right? And customer in that case might actually leave you, right? Might actually do not want to kind of do not want to deal with you for many business dealings, right? So that on the other hand will increase the distress cost, right? Because you have to take into account customer interest here. Also, for example, how to redeploy assets, right? When a firm goes through financial distress, one way to reduce this cost of financial distress is they can sell some of the company's assets, right? But if it's very difficult to sell some of the assets, then it increases the distress cost. So here is the list of the debt ratio we observe in reality, right? The highest here is electric and the gas, right? So this is the industry where you do have high initial investment, right? So that's why the debt rate, and you have large equipment there, right? So that's why the debt ratio is high. Food production is relatively low. Paper, plastic also is quite large, right? Because then you need to, so there are more machines and equipment involved in the process, right? Physical assets are involved in those production process. On the other hand, the computer software has little debt ratio, right? Because their production cost is quite low, right? You just need to devise the software program, right, basically. So this is the debt ratio here. So what does the checklist explain, right? So the checklist is here, right? So these factors. So how does that explain? So the checklist explains capital structure differences at broader level. For example, between electric, gas, and the computer software, right? For example, let's look at, so this is the debt ratio is low, right? So let's look at, for example, electric and gas versus computer software, right? So for example, cash flow volatility in the cash flow volatility in the electric and gas industry, they are quite stable, right? Because they're basically utility industry, right? Every household they need electric and gas, right? So that's why their profits are quite stable. That's why they are not afraid of distress costs, right? That's why they have a high debt ratio. On the other hand, computer software, the cash flow volatility is high, right? Because I mean, the computer software, the revolution is very rapid, right? Maybe your software will become unpopular in a year, in 2 years, right? In that case, cash flow will go down, right? That's why it's volatile, and that's why the debt ratio is low, right? The firms do not want to take a lot of debt in those industries. Now let's look at another factor, how to redeploy assets, right? Asset redeployability, basically. So again, for these electric and gas food production, for this industry, because they have lots of physical assets, right? It will be easier to redeploy assets. It will be easier to sell those assets when a firm goes into financial distress, right? That's why they are not afraid increasing their debt ratio, because they know that when they actually go bankrupt, when they actually go to financial distress, they can sell the assets, sell some units to get some money, right? To pay off the debt. But for computer software, right, they don't have much physical assets, right? So that's why when it comes to financial distress, they don't have anything to sell to pay off the debt, right? That's why they'll try to maintain a low debt ratio, right? So, but they can, so you can see this checklist, they explain the general differences, right? But they are not so good at explaining small differences, right? For example, between like food production and equipment. Right? So they're pretty close, but you cannot use the checklist to explain this, right? Because I mean, the food production and the equipment, they are very close in terms of that ratio, but yeah, cash flow volatility and asset redeployability is actually lower than the equipment industry. Right? Because food production doesn't need to use many. I mean, the value of the machine they will need to use are not very high. Therefore, in terms of asset redeployability, they are lower than the equipment. Yeah? So you cannot explain a lot about those small differences by using the checklist, right? But of course, other factors such as sustainable growth are also important, which are not on the list. Right? The key points here is that faster growing companies reluctant to issue equity end up with debt ratios greater than the target implied by the checklist. Okay? So that is because, remember, previously we talked about the cost of issuing equity, right? Because if you issue equity, shareholders will tend to discount, right? Then they will try to think that the company is overvalued. But this is bad for faster growing companies, right? Because they need equity financing to kind of finance the new projects. And also slowly growing company reluctant to buy back equity or increase dividends, they will end up with debt ratios below the target ratio implied by the checklist. Right? So you can see the kind of growth rate of the company also matters here for the target debt ratio. So this is the key points. And also keep in mind that a faster growth company that stray too far from the target ratio with excessive leverage will risk financial distress, right? Ultimately, when we think about those target debt ratio, you need to have a consistent product market strategy as well as a financial strategy, right? Now, finally, we're gonna talk about the asymmetric information problem, right here in the choice of the financing strategy, and another theory of optimal capital. We're gonna first look at the Lemon's problem here. So the Lemon's problem basically, I mean, if you're familiar with this problem, it basically came from, let's say you have a second-hand car market, right? When you go to a dealer to buy, or when you go to the second-hand car market to buy a car, right? You will look for the car you want, right? You don't want to buy a bad quality car. But ex ante, you don't know which car is good. You don't know which car is bad, right? Only the buyer knows which car is good, which car is bad. Therefore, there's asymmetric information there, right? Now, what the consumer or what buyer will do is that they will calculate the expected quality in this market, right? Even if there are good cars, even if they're bad cars, they will calculate expected quality. But when they calculate the expected quality and they have this impression for the price that is uh, very suitable for the expected quality they calculated here. Now, the expected quality they calculated is higher than the bad quality. Right? That's why the price they pay for the average car it's going to be higher than the value of the bad car, but it's going to be lower than the good car. Right? Now, in that case, good car owners they will suffer, right? Because I mean, but like a buyer, I don't know your car is good or bad, right? I will even if you're a good car, but I don't know, right? I will assume that your car is also has the average quality of the market. Therefore, I will pay less, right? Now, good car buy owners they will leave the market because they are paid less, right? Now, in that case, bad car owners they will try to enter the market because they actually are paid with a premium, right? Because the true quality is below the average quality, right? Now in that case, the bad car owners will actually profit from selling their bad car, right? So this is the Lemon's market because at the end of the day, it will be a Lemon's market, right? Because all the cars will be bad because the good car owners just leave, right? Because they are not paid well, right? They are not paid according to the true quality of their car. This is the Lemon's problem. So in the financial market, it's the same thing, right? Suppose the managers have more information about the firm than outside investors, right? So in that case, managers prefer to issue equity when equity is overvalued, right? So their shareholders actually know it, right? So in that case, stock price will decline at equity issue announcements, right? So in that case, managers to respond to the shareholder discounting, they will try to avoid issuing equity, right? In some cases, they might even forego positive NPE projects, right, rather than issuing equity, right? So let's look at this example here to look at this asymmetric information problem here. suppose we have a company called XYZ, right? XYZ's assets in place are subject to idiosyncratic risk, right? The asset value could be 150 when with 50% chance. It could be 50 with 50% chance, right? Now, suppose that there is a new investment project coming up. The discount rate is 10%. The investment outlay or investment cost is 12 million, right? Now, in that case, the safe return next year is 22 million. That's why the present value of the safe return will be 20 million today, right? Now, the NPV will be what? Will be the initial cost minus 12, right? Plus the present value of the cash flow, which will be 20, right? So the net NPV here will be 8 million, right? The question is, should XYZ undertake the project, right? Now, suppose there's no asymmetric information here. There's no asymmetric information between managers and shareholders. That is, managers know as much as outside investors, right? Now, in that case, if the project is internally financed with cash, the project, right? The existing shareholders will realize the full 8 million NPV of the investment, right? Now, suppose XYZ doesn't have the cash, but can issue 12 million in equity, right? So in that case, once the project funded, the firm is worth 120 million, right? Basically, the firm will raise the 12 million by selling 10% of the shares, right? So existing shareholders, they will get 108 million. Existing shareholder will gain actually 8 million, right? Now you can see if there's no asymmetric information here, meaning that shareholders and managers, they know the same thing, right? So they know, managers know the correct valuation. Shareholders also know the correct valuation, right? They know the same thing. Then in that case, shareholders, they will not discount the issuance of equity, right? In that case, shareholders, they gain the full 8 million here. Yeah? So in that case, with full information, no information asymmetry, managers are indifferent between internal and external financing, right? Now, let's introduce information asymmetry here. That is, shareholders, they don't know the true valuation of the company, right? They only know that with 50% chance, the company will be worth 150, right? With 50% of chance, the company will be worth 50, right? But managers know for sure, right? Managers know for sure that the company will be worth 150, right? Now, if the company does internal financing as before, existing shareholders get 8 million, right? But now, if there is information asymmetry, but the company does equity financing, now here's the problem, right? Because the shareholders, they will try to, they will still try to value, so they will still try to interpret the company's average value will be 100, right? Even if the true valuation is 150, they will still think the company is valued at 100, right? The value is 100 because you can see 50% 150, 50% 50, right? So that's why they will think that the true valuation is 100, right? So in that case, the company has to issue again 12 million by selling 10% of the shares, right? In that case, the existing shareholders, they get 153 million. Why? Because the true value here, it is 150. It's just that the shareholders do not know about it. That's why existing shareholders, they get 153. But remember, the true value of the company is 150, right? Now, in that case, existing shareholders only gain 3 million, right? You can see the main problem here is that shareholders, because they don't know the true valuation, they will try to discount, right? Discount from 150 to 100, right? That's why when equity is undervalued, managers prefer to finance internally than to issue equity, right? Because shareholders will tend to discount, right? Because of this information asymmetry. Then how about debt financing here? Then the problem is actually not there, right? Because with debt financing, there's no information asymmetry because you are just borrowing from your debt holder with this money. You promise to pay them back, right? There's no information asymmetry there. You don't have to tell. You don't have you don't have to tell the company's true valuation, right? Because the debt holder, they analyze the firm in a different way. They only need to know whether the company is able to pay off the debt or not, right? In that case, the company will will raise 12 million and repay 13.2 million, right? Existing shareholders still, they can get the full 8 million, right? So because so the conclusion here is that when equity is undervalued, managers prefer to finance with debt equity, right? Because of this information asymmetry problem. So basically, the value of the debt financing is independent of information. That's why debt financing is good, right? And managers in the market give it the same value. Safe debt is fairly priced, so therefore there's no lemons problem. If you look at the risky debt, the risky debt is somewhere between the safe debt and equity, right? So that's why there is some lemons problem here associated with risky debt, right? Because as long as there's risk, there could be information asymmetry, right? Because managers knew the true quality of the project, true quality of the company, but actually shareholders or bondholders, they don't know it, right? So with risky debt, there are some lemons problem here, right? So the conclusion again is if your assets are worth 150, you will not want to issue equity, right? But you will choose to finance internally so that you don't have to tell shareholders or with debt, right? So in that case, if you choose to issue equity, in those cases, investors will know that your assets must be worth only 15 million, right? Because they will discount it low, right? Because they know that only the firms with overvalued, so only the overvalued the firms, they will issue equity, right? So that's why they will discount. So that's why they will try to think that your company is only worth 50, right? That's why consequently the stock price will fall, right? But we don't know how much, right? So let's look at how much. Suppose assets are 150 and 50, right? With equal chances, assets are currently valued 100, right? Now, after you issue an equity, the market infers that the firm is sitting on negative information, right? Then the assets are worth only 50 million, right? Now, the market value will drop to 50 plus the project that is taken, right? It will be 70. You know? So when a company issues an equity and announces the equity, the market value will actually drop, right? And there is some evidence for this announcement effect. So basically, when a company announces to raise straight debt, there's little effect. When it's convertible debt, it's minus 2%. So convertible debt could be converted to common stocks, right? So there's a minus 2%. If it's equity, that's minus 3%, right? Whereas if you do start repurchase, it's going to be 13%, right? So we talk about this last chapter. So now, following our previous example, suppose the investment cost is 18 million, not 12 million, right? Now the NPV goes down. NPV is only 2 million, right? So in that case, raising 18 million requires selling $15 of the shares, right? So in that case, existing shareholders, what they get 80% times 150 plus 20, right? Which is 144.5, right? So you can see in this case, if the initial cost is higher and there's information asymmetry, that investors actually lose when they actually, they actually lose relative to the market value if they do not invest. In our case, XYZ, the company will not issue equity to fund the project, right? Because of this information asymmetry problem. So the key point here is that the investment depends on financing, right? Some projects will be taken only funded internally or with relatively safe debt. Information asymmetry can lead companies to forgo good projects, right? And companies with less cash and more leverage will be more likely to subject to this underinvestment problem because it will be costly for them to issue debt, right? So they're more likely to switch to equity. Then we also need to consider other factors like existing debt. High tech and high growth company can also be credible issuers of common stock because they have intangible assets convertible finance. So this is the, so now this theory, I mean, the theory that incorporates the information symmetry here when a manager chooses when manager chooses capital structure, is called a pecking order theory of financing choices, right? That is, the basic assumption here is that the managers know more about their company's prospects, risks, and value than outside investors, right? Here, the symmetric information affects the choice between internal and external finance, and also between new issues of debt and equity securities. So that's why there's a pecking order here, right? First, internal funds, right? For example, internal cash or internal equity, right? And basically also coming from reinvested earnings, right, primarily. And then after that, we go issue debt, right? Finally, the last method of financing we seek is equity financing. There's a pecking order here. So the basic pecking order is firms will use cash first, and then others will use debt, right? And then finally firms use equity, right? But for high cash flow company, there's no need to raise debt, right? In fact, they can actually repay some of the existing debt, right? So in that case, leverage ratio might decrease, right? But for low cash flow firm, they might need to raise debt, right? Because for low cash flow company, existing cash might not be enough to fund the projects, right? And also they are reluctant to raise equity, right? Because of the asymmetric information problem here. And for those companies, leverage ratio might actually increase, right? So basically, pecking order theory believes that a company's leverage ratio doesn't come from like there's optimal level of ratio. That's why we want to achieve the optimal, right? And so instead, the pecking order theory believes that the choice of the capital structure actually comes from a series of incremental financing decisions, right? I first go to internal cash, then I go to debt, finally I go to equity, right? So it's a series of incremental financing decisions. And the prediction here is that the capital structure can actually move around a lot, right? There's no precise point estimation here. So for example, profitable firms in general borrow less because they have sufficient internal funds, right? Not because they have low target debt ratio. Less profitable firms issue debt because they do not have internal funds sufficient, right? That's why they go to debt. Right? That's why they follow from the pecking order of the financing. And basically, the debt ratios change when there's an imbalance of internal cash flow, net of dividends, and real investment opportunity, right? If the firm has already used up internal funding, they will seek debt financing. So that is the first consideration following from the pecking order theory. The attraction of the tax shields is secondary in the pecking order theory of financing. And this helps actually explain the inverse intra-industry relationship between profitability and financial leverage, right? More profitable firms, less leverage. And so here's an evidence supporting this trade-off theory, right? This paper finds that the debt ratios of individual companies seem to depend on four main factors, right? Size, tangible assets, probability, market book. So this is the pecking order theory. So empirically, there is an evidence supporting the trade-off theory. There is evidence supporting the pecking order theory, right? For example, growth company, they could face high cost of financial distress and would be expected to borrow less. Yeah? This is the trade-off theory, right? Financial distress is higher, that's why they borrow less. Also, profitable firms use less debt because they have rely on internal financing, right? This is consistent with pecking order theory. Right? So basically, we find that the pecking order theory actually works best for large, mature firms that have access to public bond markets. Right? And the choice of corporate financing is also related to market timing. Right? So sometimes the stock markets are irrational, right? Firms might be overvalued. So financial managers might take advantage by issuing shares when the stock price is too high. Right? So in that case, popular firms will issue less debt and more shares because the investor enthusiasm is high, right? But unpopular firms in that case will avoid share issues and end up with high debt ratio. This is also a factor. And also manager behavior also affects the capital structure, right? So because we have this agency problem between managers and shareholder, right? Basically, managers, they want to maximize their own profits, right? But they don't maximize shareholder value, right? So that's why there is a incentive misalignment between the managers and the shareholder. Right? And what's the typical manifestation of this agency problem, right? The manifestation is free cash flow, right? If a firm has a lot of cash flow in excess of that needed to fund all positive NPE projects, this is an indication of a potential agency problem, right? Because managers in those cases might use those excessive cash to, for example, benefit themselves, right? For example, do some unprofitable investment in order to make the company bigger so that they receive higher compensation, right? And they might try to build an empire. They might invest in pet projects or prestige investments, etc. Right? So in those cases, managers, if they have agency problem, they may be reluctant to pay out free cash flow. Right? So like we talked about earlier, we talk about dividend policy, right? If the company has no payout, the corporate governance might not be very good. Right? And this problem is more severe for firms with lots of cash outstanding, right? And those firms, if they do, and they have very few good investment opportunity, that's also the free cash flow problem is also very severe, right? Which suggests that managers do have this free cash flow problem. Right? So, for example, in 1986, right, Jensen wrote in 1986 about the free cash problem in the oil industry, right? From 1973 to 1979, in the oil industry, the oil prices increased, right, by 10 times. At the same time, the oil industry expanded, oil consumption fell, right? So if you look at the oil industry at the end of 1970, there are lots of excessive capacity, right? There are also lots of cash thanks to the high prices, right? Now, there are lots of free cash flow there, but what did the managers do, right? They did not pay out cash to the shareholder, right? They continue to spend on exploration and development, right? You can see, but shareholders do not like that, right? Because they might think that these are waste of money, right? Also, these companies do not pay out the free cash flow. They invest in outside in the other industry, right? Mobile purchased the Master, Exxon purchased electric company, right? These acquisitions turn out to be very unsuccessful, right? So that's what they are managers, they're wasting shareholders' money. So now, if the company has a high leverage, that might help, right? Because I mean, if excessive cash is a problem, then I use leverage to reduce the excessive cash flow, right? So if the companies if managers cannot keep up the promise to pay interest, bondholders, they can shut down the company, right? So that's why having more debt actually reduces the free cash flow available to managers, right? Because there are less opportunity for the managers to waste the cash, right? And the commitments to pay dividends can also reduce free cash flow, right? But usually the commitment to pay dividends cannot be reinforced, but the capital structure can be reinforced. Right? So in our case, leverage buyout is such a case, right? Leverage buyout is a going private transaction, right? It basically buys another public company by borrowing a lot of money, right? By increasing the leverage a lot, and then take it as a private firm. Right? Typically, the income management acquires all the shares and then finance the deal with lots of debt. And what researchers find is that these deals, they do find post-deal, they do find operating performance of these firms actually increase after the LBO deals. Right? So that means if the debt ratio increases, that might actually discipline the manager, right? Managers will try to improve the firm, right? So that might actually be very effective, right? So basically, the LBOs improve the efficiency through having a high debt ratio. right? This is the LBO, right? Okay, so this is so much for this week.